Hi, and welcome to this video. We will continue with our Forex trading guide for you, giving you a technical analysis and chart patterns. Now that you have a solid understanding of the different patterns, a very common mistake that can lead to losing money is trading those patterns individually using the condition explained for each one of them. Understanding the pattern is an important step, but it's not the only one. Below, we will go through the thorough process of creating a money management plan for a trading cycle based on the pattern covered in this video. To illustrate that process, we will break down most of our own strategy trading using some of the patterns in the Forex market. Please understand that we are not providing you with a ready-to-use trading strategy. What works for us might not work for you. The purpose of providing this information is to show you how to build your own profitable strategy to trading the standard chart patterns. Step number 1. Determine which patterns suits your trading style. The patterns in this video have different characteristics. It will be very hard and confusing to build a strategy around all of them. Therefore, the first step is to eliminate the patterns that aren't compatible with your trading style. Below is how we filtered our own list of patterns to trade. We prefer trading continuation patterns, thus head and shoulders, inverse head and shoulders, double tops, double bottoms, triple tops, triple bottom are removed from the list of patterns we trade. The second trading preference is trading patterns that occurs more frequently in the market, that removes the cup and handle cup of our list. Since which can be continuation or reversal patterns, we only trade rising wedges when the prior trend is downwards, and falling wedges when the prior trend is upwards. That leaves us with the following pattern list: symmetrical triangles, ascending triangles, descending triangles, which continuation variants only, rectangles, flags, and pennants. Step number 2. Set up a strategy for trading the selected patterns. Once you have the list of patterns you are willing to trade, it is time to build a strategy for trading them. This strategy must include how to enter a trade, how to calculate take profit target, and how to calculate stop loss. Below is a simplified list of the conditions we use for the patterns we filtered earlier. A trade entry at the closure rate of the candle after the breakout candle. Take profit target, default measurement for each pattern. Stop loss. Each pattern has its methods, discussed thoroughly below. Step number 3. Backtest thoroughly. Now that we have the list of patterns to trade and the strategy for each one of them set, it is time to manually backtest our plan by going through the different charts, searching for all the patterns from our list that can be found, and precisely do the calculations for each finding using the strategy we have set. Of course, the larger the backtesting sample, the more reliable the results will be. We recommend finding at least 10 of each pattern. It can be a boring and exhausting process that might take days or weeks to complete, but it lays the foundation for months or even years of successfully trading to come. Step number 4. Calculate your edge and build a money management plan around it. Using the data collected from backtesting, calculate risk-reward and win-lose for all the back-tested trades to calculate your average risk-reward and win-losing, your edge over the market, and see if trading using those conditions will be profitable or not. Step number 5. Be consistent. If completing the previous step resulted in a profitable calculation and gave you the confidence to use that strategy in a real trading cycle, always remember this. You backtested the pattern and know its performance. You have a money management plan for a trading cycle. You created your own set of rules to be used in trading. Now please stick to them. Why and when do we use 7, 14, or 21% for stop loss safety? Through this video, you might have noticed that we always use one of the 3%, 7, 14, or 21% of the target measurement to calculate a safer stop loss rate beyond the absolute stop loss measurement. As discussed earlier, it is important to define in a trading strategy the rules to use for setting a method for stop loss and calculating its rate. And that is our way to approaching a constant method for calculating stop loss trigger rate. As for why we assign a certain percentage for each of the platforms, this involves tuning the basic structures and price action for each of the patterns, which is explained briefly below. Generally speaking, stop loss measurement based on a breakout of a pattern, which is always the closer stop loss, will be assigned either in 14 or 21% stop loss safely to give the trade room to breathe, while the fourth stop loss will be assigned in 7% stop loss safely since it is always a structural support. Below we will explain why each stop loss measurement is chosen for the patterns and why they are assigned their stop loss safely percentage chosen to them. In the case of the symmetrical triangle continuation pattern, the prior trend is in the favor of the trade directions. Price action inside the pattern is creating lower highs and higher lows, thus not favoring of the opposition the trade direction. The pattern is assigned two stop loss methods to choose from, due to the availability of a clear structural support and the steady price action inside the pattern. The stop loss 1, 21% of target measurement beyond absolute stop loss, since it's a structural support and may be reduced to 14 if the breakout was strong and trade entry is a bit further away from the breakout level. Stop loss number 2, 7% of target measurement beyond absolute stop loss, since it is already further away from each entry and it is a structural support. The ascending triangle continuation patterns, the prior trend is in the favor of the trade direction. Price action inside the pattern is a semi-bullish which favors the trade direction, as the equal height means that bears are holding their ground but not able to push back, while the higher lows means that bulls are gaining ground by pushing forward slowly. The pattern is assigned two stop loss methods to choose from due to the availability of two clear structural supports. The stop loss 1, 14% of target measurement beyond absolute stop loss, since it is a structural support. The stop loss number 2, 7% of target measurement beyond absolute stop loss, since it is already further away from entry and it's a structural support. Descending triangle continuation pattern, the prior trend it is that the favor of the trade direction. Price action inside the pattern is a semi-bearish which favors the trade direction, as the equal slow means that bulls are holding the ground but not able to push back, while the lower height means that bears are gaining ground by pushing forward slowly. The pattern is assigned two stop loss methods to choose from due to the availability of two clear structural supports. Stop loss number 1, 14% of target measurement beyond absolute stop loss, since it is a structural support, and stop loss number 2, 7% of target measurement beyond absolute stop loss, since it is already further away from entry and its structural support. Head and shoulders reversal pattern, the prior trend is opposite the trade direction. Price action inside the pattern is a semi-bearish which favors the trade direction and weakens the prior trend by three different resistances, head plus two shoulders, with the last resistance, right shoulder, being lower than the previous one, the head, which means that bears are gaining ground and pushing forward. The pattern is assigned two stop loss methods to choose from due to the availability of two clear structural support when the pattern isn't skewed. The stop loss number 1, 14% of target measurement beyond absolute stop loss when the pattern isn't skewed, and the neckline is a structural support in that case, or 21% in skewed patterns, as support in that case isn't structural. The stop loss number 2, 7% of target measurement beyond absolute stop loss, since it is already further away from entry and is a structural support. Inverse head and shoulders reversal pattern, the prior trend is opposite the trade direction. Price action inside the pattern is a semi-bullish which favors the trade direction and weakens the prior trend by three different resistances, head plus two shoulders, with the last resistance, right shoulder, being higher than the previous one, the head, which means the bulls are gaining ground and pushing forward. The pattern is assigned two stop loss methods to choose from due to the availability of two clear structural support when the pattern isn't skewed. Stop loss number 1, 14% of target measurement beyond absolute stop loss when the pattern isn't skewed, as the neckline is a structural support in that case, or 21% in skewed patterns as support in that case isn't structural. And stop loss number 2, 7% of target measurement beyond absolute stop loss since it is already further away from entry and is a structural support. Thanks for watching. We hope you learned with our content. Please join us in future videos to continue with this series.